Imagine two people. We'll call them Alex and Brian. Alex makes $75,000 a year. He drives a 5-year-old Toyota, lives in a modest apartment, and honestly, he feels like he's just doing okay. Then there's Brian. Brian makes $150,000, double what Alex makes. Brian has the Tesla, the house with the quartz countertops, and the Instagram feed that looks like a vacation brochure. If I asked you who's going to be a millionaire first, you'd point at Brian without even thinking, right? I mean, it's double the money. It's basic math. But here's the thing. After looking at the data, analyzing tax brackets, and studying the psychology of how we actually spend money in 2026, there is a very high statistical chance that Brian is actually broke. And Alex? Alex is the one quietly building a fortune that Brian will never see. Look, we've been lied to. We've been told that a high salary is the same thing as being rich. It's not. In fact, for many people, doubling your salary is the fastest way to ensure you never retire. My name is Zahid. I work in finance. I have my MBA. I'm a CPA candidate. And I spend way too much time studying how people actually build wealth. If you're someone who earns a decent income but still feels like you're not getting ahead, hit the subscribe button and give this video a thumbs up if it helps you out. Let's start with the most obvious hurdle that no one wants to talk about: the tax friction. As a CPA candidate, this is where I see the most wealth leakage occurring before the money even hits your bank account. Most people think that if you double your salary from $75,000 to $150,000, you double your take-home pay. No, not even close. You see, the US tax system is progressive. When Alex earns $75,000, a large portion of his income is protected by the standard deduction and lower tax brackets. After federal taxes, Social Security, and Medicare, he's taking home roughly $58,000. Now look at Brian. When he jumps to $150,000, those extra $75,000 aren't taxed at his starting rate. They are piled on top, pushed into the 22 and 24% federal brackets, plus state taxes, and the Social Security cap hasn't even been reached yet. In high-tax states like California or New York, Brian might only see 60 cents of every extra dollar he earned. He's working twice as many hours or taking on twice the stress, but the government is taking a significantly larger commission on his success than they are on Alex's. This is where it gets really interesting. Because Brian feels rich, he starts spending based on his gross income, that big number on his contract, not his net income. He sees $150,000 and thinks, I can afford a $4,000 mortgage. But after the tax man takes his cut, that mortgage is eating 60% of his actual take-home pay. Brian is house poor at a 6-figure salary, while Alex is cash rich on a modest one. Now let's talk about the cost of convenience. When you earn $150,000, your time becomes your most expensive asset. Or at least that's what you tell yourself. Brian starts outsourcing everything. He doesn't have time to cook, so he uses food delivery apps 3 times a week. That's a 40% markup plus tip on every meal. He doesn't have time to clean, so he hires a service. He doesn't have time to wash his car, so he pays for the premium detail. Individually, these seem like rich person moves. Collectively, they are a massive drain on his wealth efficiency. Alex, making $75K, still has the scarcity mindset that protects his wealth. He cooks at home. He washes his own car. He realizes that a $20 delivery fee is actually 2 hours of work after taxes. By maintaining his own life, Alex is effectively paying himself a tax-free dividend every single month. I call this the status tax. When you make $150K, the world expects you to look like you make $150K. Your neighbors have the manicured lawns. Your coworkers are wearing the $300 boots. There is an invisible pressure to inflate your life to match your paycheck. Alex has the luxury of invisibility. No one expects him to drive a Porsche. He can save 20% of his income, about $15,000 a year, without anyone batting an eye. Brian, trying to keep up with the high earner crowd, often finds himself with a savings rate of 0. Sometimes it's even negative, as he leans on credit cards to maintain the $150K image while only having a $90K lifestyle after taxes and fees. Here's the thing. If your expenses rise at the same rate as your income, you aren't getting wealthier. You're just consuming more expensive things on your way to being broke. Let's look at the compounding math. This is the part that usually shocks my clients. If Alex saves $1,000 a month, which is tight on a $75K salary but doable if you're disciplined, and invested in a total market index fund at an 8% return, in 30 years, he has $1.4 million. Now look at Brian. Brian is rich. He makes $150K, but because of his debt, the Tesla payment, the $4,000 mortgage, the premium lifestyle, he only manages to save $500 a month. In 30 years, Brian has $700,000. Alex, the lower earning man, has double the wealth of the rich man. This is the silent tragedy of the American middle class. We are so obsessed with increasing the input, the salary, that we completely ignore the efficiency of the system. It's like having a car with a massive engine but a hole in the gas tank. Brian has a Ferrari engine, but his tank is leaking 90% of the fuel. Alex has a Honda engine, but he isn't losing a drop. Who goes further? But it gets even deeper when we look at investment fees. Brian, because he's wealthy, often gets targeted by wealth managers who charge a 1% assets under management fee. Alex just buys a low-cost index fund with a 0.03% fee. Over 30 years, that 1% fee can strip away an additional $300,000 from Brian's portfolio. Brian is being penalized for being a high-value target for the financial services industry. Now, let's look at the Gilded Cage effect. This is a psychological phenomenon I studied during my MBA. Because Brian has such high fixed costs, the massive mortgage, the car payments, the private school tuition, he has zero risk tolerance. He is a slave to his $150,000 salary. If his boss asks him to work through the weekend, he says yes. If his company becomes toxic, he stays. He cannot quit. He cannot take a risk on a new business venture. He is one layoff away from losing everything. Alex, with his $75K lifestyle and his growing $1.4 million portfolio, has something Brian will never have. FU money, which you know what I mean. Because his cost of living is low and his assets are high, he has the leverage. He can walk away. He can take a 6-month sabbatical. He can pivot careers. The greatest irony of personal finance is that the more you earn, the more likely you are to build a gilded cage for yourself. You think the money is buying you freedom, but if your spending rises with your income, the money is actually buying you a heavier set of chains. So how do you avoid Brian's fate? How do you actually get richer when your income increases? You need to implement what I call institutional controls for your life. In accounting, we use internal controls to prevent fraud and waste. In your life, you need them to prevent lifestyle fraud. First, follow the 50% raise rule. If you get a $10,000 raise, you are allowed to spend $5,000 of it on improving your life. Go ahead, get the better coffee, take the nicer vacation. But the other $5,000, it must go directly into your brokerage account before you ever see it. Second, perform a subscription audit every 90 days. High earners are notorious for leakage. Subscriptions for apps, streaming services, and memberships they don't use. If you wouldn't walk to a window and throw $20 out of it every month, don't let a company auto-draft it from your account. Third, understand the difference between income-producing assets and status-producing liabilities. Brian's Tesla is a liability that loses value every day. Alex's index fund is an asset that works for him while he sleeps. By doing this, you are baking in your success. You are ensuring that your wealth grows faster than your lifestyle. This is how you keep the efficiency of Alex while gaining the firepower of Brian. That is the secret formula to becoming a quiet millionaire. Look, at the end of the day, the number on your W-2 is just a vanity metric. Your boss, your neighbors, and the bank might be impressed by a high salary, but your future self only cares about one thing: your net worth. The reason I started this channel is because I'm tired of seeing people work 60 hours a week just to end up with nothing to show for it but a leased car and a mountain of stress. On this channel, we don't care about looking rich. We care about being rich. We talk about the math, the taxes, and the psychological traps that the financial industry doesn't want you to understand. If you're ready to stop playing the status game and start playing the wealth game, make sure you've subscribed. This is a place for the quiet millionaires, the people who are building freedom in silence. I've got a lot more deep dives coming on how to optimize your taxes as a high earner and how to accelerate your path to the first 100K. So stay tuned for those. Stay silent, stay focused, and keep building.